Hi, I'm Maribel Valencia,
And I'm Larry Gomez.
and this is our financial analysis of Nike LLC and Skechers Inc. So Nike LLC shareholders, 86.7% of Nike is owned by institutions. They have 2,439 institutional shareholders, and then Skechers Inc. has 91.37 shares that are owned by institutions. And then Nike and Skechers have three common shareholders. They have Vanguard Group Inc., FMR Inc., and the Bank of New York. So why do investors care about the cost of capital? There's three reasons why they care about the cost of capital. It evaluates one's business, and for investors, it evaluates the risk of the business. Some advantages are not giving up any equity in the business. When you need a debt finance, sometimes you don't have to give up equity. It creates more tax deductions for you. Some disadvantages are that it might impact your credit, and sometimes when debt financing you have to put up collateral, putting your collateral at risk. The cost of capital. So the cost of debt for Nike is 2.53%. The cost of equity is 7.54%, and the weighted average cost of capital is 6.27%. Skechers had a cost of debt of 3.30%, cost of equity of 7.22%, and a weighted average cost of capital at 4.57%. Some influences on the debt ratio are the tax rate and the default spread. Nike and Skechers both had the same default spread of 0.63, and Nike's tax rate was 3.02, and Skechers was 3.30%. And so the cost of debt was for Nike 2.53%, and Skechers was 2.84%.
With the regression function in the Excel, we were able to calculate Nike LLC and Skechers Inc. 5-year monthly stock returns. Here in the graph, we notice that Nike's beta came out to negative 3.234, and Skechers Inc.'s beta came out to 0.3889. Can we lower this by changing our capital structure? Looking over the financials, we notice that Nike and Skechers both have a current interest expense that's very high. This could be due to advertising throughout the year, coming out with new product. To be safer, we would go with Nike because of the revenues that they produce throughout the year. And then how would a financial restriction affect the value of our company? Just looking at the financials, for Nike, first of all, the current debt to equity ratio is 25.41%. If you increase that up to 40%, their net loss would be $16 billion. For Skechers, their current debt to equity ratio is 60.48%. If you increase that to 70%, their net loss comes out to $3.901 billion. Would more debt create unnecessary risk? It would. More debt added would restrict a company's ability to raise additional capital, which has the potential to prevent a company from getting the cash it needs if it gets into a bind. Not only would it restrict the company's ability to raise capital, but taking on more debt would make it more difficult to keep on with ongoing business expenses. And then what does the competition do? As you can see, Nike, LLC, Under Armour, Adidas, and Skechers both have a good amount of revenues, but if we compare the revenue, market cap, and net income, we notice that Nike is above all other companies. And then finally, is our stock fairly valued? Nike's December 31st, 2019 stock price was $101.31 per share. At the beginning of our analysis in February 2020, the stock price was $103.54 per share, which decreased $2.23 per share. For Skechers in December 31st, 2019, the stock price was $42.60 per share. And in the beginning of February 2020, it was $37.83 per share, which had decreased by $4.77 per share. And is our stock fairly valued? We would consider it to be fairly valued. And thank you for our presentation.
Thank you.